thinks and says. The other issue, which is maybe gives us near-term concern.
You get China to play ball in whatever mechanism you've got, and in exchange you add dollar.
Of that was that the yen was then deliberately weakened to put even more pressure on China from a competitiveness standpoint. And the weak yen, I think, is part of that sort of Trojan horse or whatever, which is forcing the Chinese to act.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.
Thinks and says. The other issue, which is maybe gives us near-term concern but long-term salvation, is China, where China is currently seeing extreme debt deflation, where the PBOC has taken a whopping amount of liquidity out of the markets in the last 4 to 6 weeks, trying to hold the yuan up against the rising dollar. And
that's coming from that. How do you measure this shorter-term funding dynamic? In what does that show up as stimulus? Because that's not something that most people are capturing. I read your stuff, and I know you've been talking about it a lot, and it makes sense. But does it get captured elsewhere? Or do you have to just look at Bullish in its own right and add that to liquidity measures?
You mean you're talking about the funding, how she's changed funding?
That's right, the very short-term debt.
Well, what I've done, there's actually a slide in a pack I sent you, which is actually slide 25, which you can slide into the chat. Janet skewed the issuance calendar away from long-dated coupons towards shorter-dated ones, and she's taken about a year and a quarter on average out of the average, Treasury auction.
Does that change the debt refi cycle, or does this just get mopped up in this kind of final year of the debt refi cycle, the 4-year cycle? Or have they restructured it where we're going to end up with, as opposed to a 4-year average cycle, we end up with a 2.5-year cycle?
Well, that could be the case, couldn't it? It could be. And we know the structure of the Treasury market is itself quite fragile because, foreigners are not really buying American debt anymore in the size they were. A lot of it's coming down to hedge funds. Those hedge funds, as you will remember, they're fairly fickle, or certainly short term. They want to earn a profit. And as the yield curve is steepening, the cost of hedging is going up the whole time. So often, as you will recall, you see breaks in markets where suddenly people just bail out. And that's the problem that
Basel IV coming in as well. Do you think this new administration will follow the Basel IV thing? Because I think it's in place in Europe now, or at least starting. And then the UK.
Yeah, there's talk about delaying it, but generally they're moving faster than the US.
And that to me just seems another way of just forcing banks to hold more of the bonds.
Yeah, that's all it is. Yeah, exactly that. This is financial repression sort of in practice. This is what's going on. They need more and more people to hold the debt. Yeah, so there are routes out. I accept. But it's getting to the stage where you need that central bank impetus.
And how do you think that plays out in the US? Have you said Canada's started doing something, but what is your hunch that the US just continues in the debt monetization path, and that even though we can't see it clearly yet, there's relatively obvious paths?
Well, I think it does, because that's already in the data. If you look at the C rundown, they'd have to restart QE again. And we're more or less there. So it's got to come. I don't know how the markets react.
In one of the recent Fed minutes, there was reference to the drawdown of the TGA, and then saying they have to be careful not to allow the rebuild of the TGA to tighten liquidity.
Yeah.
So maybe that's the pocket of time. You draw it down into March, the opinion that it probably lasts into the back end of the year.
Well, I think that my view is that it's as it is now. It lasts into the back end of the year, I think, unless something changes. What could change is, the Federal Reserve decides not to do a QE, although that would be clearly suicidal, but it might be the case. And the other is really uncertainty over China. Now, we can talk about China later, by all means. I think it's a big, big topic. But the way that I see it,
you get China to play ball in whatever mechanism you've got, And in exchange, you add dollar liquidity into the global system and allow the dollar to weaken. Whether it's, I think the TJ is part of it, but my guess is whether it's swap lines elsewhere, whatever, just to get it into the euro-dollar banking system. And then China is free to stimulate. As you said, it needs to do a gigantic debasement of its own currency, of its monetization of its debt as stimulus. It needs to do that, but it can't do it without losing.
It was definitely swinging. Make no mistake, the problems in Europe right now.
Yeah, I mean, the dollar is cyclical. So on a secular basis, because 50% of the world's debts are in dollars, it's going higher because there's always a shortage of dollars. So we get that. Every time liquidity comes out of the system, the dollar goes up.
Yeah.
But at this point in the business cycle, with the ISM survey still low, China in recession, Europe in recession, essentially, they all have to stimulate because in the end, if China picks up, they buy more treasuries.
Yeah.
Yeah. There's the stand why we're talking about all of these is because the dollar is the dominant driver of global liquidity because global liquidity is priced in dollars essentially, right?
Well, I think it's certainly a key factor. Yeah. For the reason that a lot of lending, as you rightly say, is dollar based. So that's key. And then if you look at how central banks run their policies, a lot of them are actually focused on the exchange rates anyway. So if you start to see a very strong dollar, you may well get tightening. It just has to happen.
And as we know, the thing every economy with high debts and aging populations fear is a debt deflation because the real cost of your debt keeps going up. And the answer is and has been led by Japan and is always monetization. There's no other way around it. What are the Chinese going to do? Just let the economy burn to the ground, which is what a lot of commentators suggest. And I'm like, actually, it's the opposite because the
percent increase in their liquidity base. And that's really why you need this big devaluation. Now, the rest of the world ultimately will have to create liquidity too in the longer term. And one of the things that I focused on before, which is yet another bogey to jump, is this issue that you've got a debt maturity wall coming back into the markets from all this debt that was turned out during the COVID crisis. So at the end of the day, what we know is that liquidity has to keep rising. Probably said this before, but I think that the whole weak yen is very much a deliberate policy to basically hold China's feet to the fire. And the timing of that and the scale of the move is interesting. But I've never seen a major currency, particularly yen dollar, fall with the speed it fell in such a short time. Before, markets don't do that to currencies, only governments do. For that was that the yen was then deliberately weakened to put even more pressure on China from a competitiveness standpoint. And the weak yen, I think, is part of that sort of Trojan horse or whatever, which is forcing the Chinese to act. So I think, yes, it's true. Will they do anything to correct the weak yen? I just don't think they can because their scope for raising interest rates is so limited given the interest bill that they've got. They're in the same
help somewhere.
Yeah, absolutely. But I think the only solution is ultimately monetization because they're losing their funding sources. I think in the case of Europe, it's tricky, but then the ECB has allowed a sort of degree of freedom, so they can probably start to expand liquidity. But again, it's and we've seen that in small measure with France. We've seen it definitely in the case of the UK, where yields are higher than under the Liz Truss disaster. Germany, we've yet to look. I mean, we've yet to see what happens after the election, but who knows? But I mean, none of these countries are in a great position, as we know.
What do the Bank of England say about this? I've not kept up with what their
generation of global liquidity because everything is collateral based these days.
Yeah, there's a lot that has to happen, and there is no way around it because we've got this debt rollover. Everybody's got to do it, whether it's China, the UK, the US, Europe. There's not enough liquidity in the system. But the question I want to ask you is, why are they still...
It is. Now, in terms of size weighted, it's not quite as impressive as that because what you've got is recently China and Japan have been tightening a bit. But generally speaking, that World Central Bank Liquidity Index is actually bottomed, around late 2022. And it's shot higher dramatically in the last 2 years, which is explaining this sort of everything bubble. Now, there's a heat answer. It's probably got to be the US. And I think the US has got to move back to some sort of QT pretty quickly, as we've been saying.
Back to QE.
QE, beg pardon. I've got to move back to QE pretty quickly. I think we're agreed on that. I think the scale will be China, because China just needs so much more liquidity in a short space of time. So as I said, if you look at one of the things that if you investigate what's going on within the announced program demanding safety and safe assets in China, and that's really the issue. So the situation is getting bad. And, as you rightly say, no government wants to oversee a collapsing banking and financial system, which is what debt deflation brings. And so China is definitely this is 1930s America looming.
To me, it feels like 2025 is potentially a perfect storm for liquidity, right? All of the chicken, it gets rid of most of the sins. Do you think yield curve control is an easier way to do it?
Well, my view is that I think to come back to the financial repression point, I sort of get the financial repression. I kind of agree with that. I think the issue is that there's a lot in there.
So it does its job, as you say. It's never going to make you rich in purchasing terms, because it'll be the same as real estate or even the S&P 500. It kind of just
it's a hedge.
It's a hedge. But yeah, Bitcoin's been vastly different because it's a technology, so it's got an adoption effect as well. So you've got it's kind of gold squared, which is fantastic because it really helped young
to preserve your wealth. A lot of this is actually maintaining wealth levels. That's the critical thing now, in real or purchasing power parity terms.
And it's interesting to see how few people really still get this. A lot of people still saying it can't last. There's going to be a collapse. I'm like, there can't be a collapse. They've taken the left tail out of the risk out of the entire economy, because if every time you look to see collateral values falling too much,